Led by core Western European markets and the beginnings of a recovery in Southern Europe, 2013 witnessed exceptional investment activity to close the year, including markets hit hardest in the Eurozone. Today, there is certainly a greater risk for appetite, led by private equity groups now seeking high-yielding opportunities. Capital from Asia and more recently from North America and the Middle East have led the way. There continues to be strong demand for core investment products in CBD markets such as central London and the major German cities. More opportunistic investors are targeting what are seen as recovery markets in Italy, Spain, Portugal, Ireland, and in Central and Eastern Europe. After a prolonged period where European debt strategies were dominated by extensions and forbearance, we are now seeing lenders taking a more aggressive stance in dealing with their non-performing property loans. Look for more loan sales in the year ahead. With commercial real estate activity picking up materially in Southern European countries in the second half of 2013, the speed with which the debt markets in Europe return to more normalized conditions could be surprisingly fast. London's popularity among domestic and overseas investors continues unabated, but investor perception has changed significantly from London being seen as a safe haven for core assets to attracting more diverse capital as improved property-level fundamentals increase the appetite for risk. It is interesting to note that in the fourth quarter of 2013, Greater London investment volume surpassed the peak levels seen in 2007. The UK's political stability, tax and legal environment places London among the world's premier investment destinations. Only one of the 10 largest transactions in London in the fourth quarter of 2013 was acquired by a UK-based buyer, which underscores the appeal of London as a destination for global capital. In addition to more typical capital flowing from North America and the Middle East, capital from Malaysia, China, and South Korea view London as a stepping stone to further real estate investment in Europe. We expect this trend to continue and to accelerate in 2014. German investors have been highly focused on their home market in recent years, and this focus intensified in 2013. However, the number of foreign buyers targeting the German market has also increased, with international investors from more than 20 different countries making acquisitions this past year. Frankfurt in particular has seen a substantial proportion of investment from outside of Europe. In Germany, France, and the UK, there are still a large number of risk-averse investors focused on core markets and prime assets. However, opportunistic investors are growing in number and in spending power, and this is driving increased investment in Europe's peripheral markets, including those hit hardest by the Eurozone crisis. Italy, Spain, Portugal, and Ireland all recorded more than twice the total value of commercial real estate investment in the fourth quarter of 2013 when compared to the same quarter in 2012. Increased transactional activity in the Irish market in 2013 also surprised many. Volumes more than tripled over 2012 as the process of deleveraging picked up pace to meet investor demand. We expect this trend to continue in 2014. Activity levels in Central and Eastern Europe proved to be more active in 2013. Austerity measures applied in recent years in the Central European markets have set the stage for the year to come. While political unrest causes some concern in the short term, on the whole, sentiment has become much more positive with a wider range of investors. Russia and Poland remain the drivers of CEE volumes. These countries accounted for over 80% of the volumes in the fourth quarter of 2013. However, increased levels of investment were seen in Hungary, Romania, Croatia, Slovakia, and the Ukraine. These markets have been flat in recent years. Two types of capital are at work in the Eurozone: that which comes into the European market from other parts of the world, and cross-border European capital, which moves in and around and within Europe. Capital from outside the Eurozone has tended to concentrate on large, core, high-profile assets in European gateway markets and sets the tone both in terms of market turnover and pricing trends. The top 10 European cities, specifically London, Paris, and major German cities, boast a very high proportion of the activity due to the transparency, overall liquidity, and a steady flow of the right type of investment opportunities available in these markets. Investments from North America into Europe have tended to come in the form of fund investment vehicles. These funds often invest on behalf of institutions, but are more likely to use leverage, are more focused on returns as well as diversification, and invest in a wider range of locations and are more likely to look at value-add and opportunistic acquisitions. Investors from North America have heretofore shown a strong bias towards Germany. Buyers from the Middle East are more diverse in nature, with capital spanning the spectrum from sovereign wealth funds to private capital. A disproportionate amount of Middle Eastern capital is invested in alternative sectors, particularly hotels, and has been more focused on France and Germany. Investment from Asia has tended to be more direct by institutions, sovereign wealth funds, pension funds, and insurance companies, as well as ultra-high net worth individuals, and is concentrated on a relatively small number of locations with a strong preference for the UK office sector. Notably, investors from Asia have the largest average lot size for their transactions. Looking ahead, Europe will be a natural home for much of the real estate allocation from global capital flows, as long as its markets retain their predictable rule of law, the characteristics of transparency and liquidity, while also offering diversification benefits against assets that are denominated in or pegged to the dollar. An improving Eurozone economy certainly helps. There is no reason to expect these fundamentals to change in the foreseeable future, and we can expect capital from outside the continent to continue influencing the European market in the years to come. Capital from China, Japan, and Taiwan, as well as Thailand, Indonesia, and ultimately India, will increasingly invest in Europe. Also expect to see more significant impact from new market entrants, including sovereign wealth funds from emerging companies where natural resources are only now starting to be harvested, such as Kazakhstan, Azerbaijan, and a number of African countries such as Angola. They will show more increased potential.